Here, and today we're going to be starting a series of sorts. It's not going to be something that's necessarily done on a particular day of the week. I'm just going to put these videos out as I get done with them. But what they're going to be going over is just indicators. So we're going to be going over a variety of different indicators and how these indicators work. For episode number 1, we're going to be going over moving averages. So before I get started with this, we're going to be going over 2 moving averages today, the simple moving average and the exponential moving average. I'm going to give you an idea of how they're calculated, how they work, and how you can apply them to your trading. So before we get started with this, I just want to give a brief rundown. I will be doing all of this on TradingView.com. So if you're not familiar with the TradingView platform, this will help you become more familiar with it. It is the same if you're going to use it on any of your trading platforms like MetaTrader 4 or any of your broker-specific trading platforms. It's the same concept. It'll work the same. This is just going to be done on TradingView because that's what I use to chart and that's what I'm familiar with. But like I said, it will apply to all of the other broker platforms as well as MetaTrader 4. So getting started, we have to kind of understand how moving averages work. It's much simpler to explain the simple moving average, so we're going to start with that. And essentially how the simple moving average works is you assign the moving average a time frame, and that time frame is taken into account when factoring the moving average or the average for that time frame. So for example, if we were using a 10 simple moving average, that would mean 10 time frame closes. In this case, since we're looking at a candlestick charts, I'm going to refer to it as candlesticks, but it applies the same with line charts and so on and so forth. So we're looking at candlesticks. If we apply a 10 simple moving average to this chart, we'd be looking for the average of 10 candlesticks. And the way that this is calculated is, let's say that we have price starts at 5, goes up to 6, goes back down to 5. That's our third point, goes back up to 6. That's our fourth point, goes up to 7. That's our fifth point, goes back down to 6. That's our sixth point, goes back up to 7. That's our seventh point, goes back down to 6. That's our eighth point, goes back down to 5. That's our ninth point, and then goes back up to 6 for number 10. Let's go ahead and throw some numbers on this so that it makes more sense. Pick a color. Let's just keep it simple. We'll do black. So that's going to be 5. 5. Then it goes up to 6. Back down to 5. Back up to 6. Up to 7. Back down to 6, up to 7 again, back down to 6 again, down to 5, and then back up to 6. Alright, and the way that this is calculated is you're going to take 5 plus 6 plus 5 plus 6 plus 7 plus 6 plus 7 plus 6 plus 5 plus 6, which would be 6, 12, 18, 24, 30, plus 15 is 45, plus 14 is 59. So you're going to take 59, divide that by 10. Your moving average for that close is going to be 5.9. We'll change the color of this. And that's how the moving average is calculated for the current candlestick. Alright, so your moving average will be that. Let's go ahead and draw a moving average, assuming that price closed above 5 to start out with. So we're down, then we're up, then we're back down, then we're up some more, then we're back down, then we're back up, then we're back down, down, and then price closes slightly below where the number 6 is. So that's the moving average represented as price moves. So each one of these candlesticks that closes, I know that this is a line chart, but each one of these that closes, this would be a different moving average than this one. This would be a different moving average than this one, and so on and so forth. That's why the line consistently moves. And the way that the way that you can think about this is every single time that the next candlestick paints or closes, then you take away this number, and the same equation happens, just starting with this number instead of starting with this number, and adds another number on the end. So that's the way that the simple moving average works. I know that this is kind of a shoddy drawing, but so that you understand the way that simple moving averages work, that's the way. And then for exponential moving averages, I'm not going to bore you with the mathematics because it is quite a bit more complicated. And it would take me much longer to explain. But essentially how exponential moving averages work is there is a weight applied to each candlestick close, which basically on a chart just means that the exponential moving average will always stay closer to price than the simple moving average will, because there is a slight weight given to the later candlesticks instead of the earlier candlesticks, whereas the simple moving average is the average of all candlesticks with no weight. So let's look at this on a chart and kind of get an idea for what this looks like. So we're just going to keep this with 10 right now for the value. Keep it consistent. Alright, so we have on TradingView it says moving average. That is just the simple moving average, and then we'll also throw in the exponential moving average, and we will give these input values 9. We are going to base this off of the candle close. You do have a couple options here: the high, the low, the open candle, and then all of these down here, which I don't mess with. I always want to keep this on close. Personally, that's how I do it. We're going to make the line a little bit thicker, and you don't have to worry about any of these. Alright, so that's the exponential. We'll do the moving average exactly the same. Change the color to let's not do the radical blue. We'll keep it green. And we'll change that to 10. So zooming in on this is UJ on the 4-hour time frame. You can see both of these moving averages have a 10 value assigned to them, which again just means that they take 10 candlesticks worth of price data and find an average in them. And so you can see that the blue line represents the exponential moving average, and you'll be able to see that in moves, the blue line or the exponential moving average will always stay closer to where price is. And the reason for that again is because the exponential moving average is weighted, and so it takes longer for the simple moving average to catch up with price, if you will. The exponential moving average keeps up with price on a much faster pace. So that's how these two are calculated. Again, if you really do want to know how to calculate the exponential moving average, there are plenty of websites out there. Do a Google search for the equation for exponential moving average if you want a better understanding of how that works. Like I said, it's just going to take longer for me to explain that equation, and in reality most people don't really care about how it's equated. They just want to know how to use it in charting, so that's what we're going to go over next. So there's a couple different ways that you can apply moving averages to your trading. The easiest way, and what most people use moving averages for, are either depicting the trend, which if you're going to be depicting the trend, then you're going to want to use higher numbers for your moving averages, something around at least the 50, if not higher than that, even the 100, the 200, the 500, the 800, something along those lines. That will give you a much better understanding of what the long-term trend is for a pair. The other common use is to use it as moving support and resistance level, or some people will refer to it as a moving trend line. And those are both the most common ways that moving averages are used. And so what does that mean? Well, I'm going to take off one of these. Me personally, I use the exponential moving average because, like I said, it's closer to price. It's what I prefer. There is no benefit to using one over the other. It's just whatever one makes more sense to you is the one that you should use, or you don't have to use them at all if you decide that it's something that you don't want to use or that you're not comfortable with using. But for me, I am going to keep the exponential moving average. And so what we can see here is on large moves, where we see, let's go ahead and see right here. So price right here is below the moving average. We had this break below, and it's respected the moving average, respected, broke above. All right, now it's respecting the moving average, breaks back down below, respects the moving average. You can see these wicks are touching the moving average, and it keeps respecting them. And a lot of times, very simple trading style, trading technique is to just trade based off of rejection of moving averages. And that's fine. There's nothing wrong with that. It might work 60% of the time. 50 to 60% of the time, I would say, is what you're going to have with rejections of moving averages, where if you have consolidation zones, that's where you're going to get burned if that's the only thing that you're basing your trading off of. Something like this area right here. Let's see here. Let's get our rectangle. Something like this area right here, where we have price consolidating right on the moving average. So price had pushed up, came inside of this consolidation area, price broke below and respected it, continued down. Then we had this bullish candlestick, which if you were trading this and you got in after price broke below this moving average, then you would have been stopped out at break even more than likely. If not, then you would have been stopped out in the negative. And then price obviously respected it once it broke through, respected it, so you could have gotten into a buy right there. Then you would have also gotten stopped out again because price broke back down below. And so that's the problem with only relying on moving averages to trade, especially with longer term or longer time frames. Scalping, I guess, could be a little bit different, and normally you wouldn't scalp on a 4-hour time frame like this, but commonly what you'll see is you'll see multiple EMAs on the charts, something like the 10 and the 20, or the 8 and the 20, 10 and the 25, something like that. And some people will get as extreme as having 9 or 10 different moving averages on their charts at all time. So for example, let's go ahead and assign some of these values. We'll take this one, we'll have this one be the 20, and let's see here, we want all of these lines to be a little bit, maybe not that thick, but give that one the green one. So then we'll make this one the 50, make that a little thicker, purple is fine. Make this one the 200. Again, make this one a little bit thicker, and these are all based on close. And then the last one we'll do as the 800. And a lot of times the way that people trade this, or the way that people view this, is whenever you see EMAs crossing each other, that's a lot of times interpreted as a change in trend. So for example, we had indicators crossing right here. That signifies a change from a bearish market to a bullish market, and you can see price broke through the 10, the 20, and the 50 EMA, and then kept on respecting those EMAs. Then it broke through the 200 EMA, and let's see if the 800 EMA is way up here. So, and then you can see that the higher the EMA number, the more respect price has for it. So, for example, with the 10 and the 20 EMAs, you can see that price just kind of dances around them. The 50 EMA, you have a little bit more respect, where you can see price breaks through here, respects it again, breaks through, respects it again, breaks back through, respect, break through, respect, and then breaks through, respect it, and so on and so forth. But with the 200 EMA, you'll notice that price isn't close to it right here, so this is clearly a bearish trend according to the 200 EMA. And as price approaches the 200 EMA, it respects it right there, respects it again, finally breaks through, and now we have this double bottom on the 200 EMA. Let's go back in time and see if we can knock out some more respect on the 200 and even the 800 EMA, as you can see right here. I guess I should have changed the color of this. Let's go ahead and make this red. So you can see the 800 EMA is respected almost perfectly. Price on UJ respects the 800 EMA, as you can see. So a lot of times what people will do is they will wait for higher time frame moving averages, and as price approaches them, they will wait for price to react. Something like this, where you can see this is a clear cut. If you know candlestick analysis, that's a bullish engulfing candle on the 800 EMA. That would have been a pretty simple buy, and you would have had a relatively good risk-reward ratio right there if you got in at the close of the bullish candlestick. Your stop loss would be below that structure as well as below the 800 EMA, and then, you know, let's say 3-to-1 trade. There's your trade. You would have hit take profit. So that's how a lot of times people will trade on the higher number EMAs, or the higher time frame EMAs, timeline EMAs, I should say. And that's, in essence, that's how people use them. They use them as a moving trend line or a moving support and resistance level, and they trade based off rejections or breakthrough and retest, just like we teach with trend lines and with support and resistance levels. You're waiting for either rejection of the support and resistance or rejection of the trend line with a candlestick reversal pattern, or you're looking for a break and a retest of those levels. And occasionally you will get faked out, you know, something along the lines of, with a higher time frame EMAs, you could see something along the lines of this, where you'll get rejection, clear rejection off of the 800 EMA, and then price barely rises above. And that's a lot of times why people will include other EMAs on their charts as well, because you can see price rejected the 800 EMA, came back and was also rejecting the 10 and the 20 EMA, and finally broke through the 800. So you'll see a lot of times that people will keep those shorter time frame EMAs on their charts as well, and just kind of try to analyze where price is going based off of what the EMAs are showing them, instead of what the candlestick or market structure or anything else is showing them. Now, me personally, I like to use a number of things, a magnitude of things, when looking for confirmation to get into a trade. I look for not only EMA rejections, or I look for, you know, price being around or far away from EMA levels. I use candlestick analysis. I'm a firm believer in candlestick analysis. Market structure is also a huge thing. So while EMAs can show you trend direction, I much prefer market structure to depict trend for me instead of using the EMAs. Really, the only thing that I use EMAs for are rejections. So maybe opportunities to trade a rejection of an EMA. Something along that line is what I'm looking for with moving averages, specifically exponential moving averages, because, like I said, I don't use the simple moving average, but they work almost the same. So hopefully you can take this and you can apply it, mess around, find some moving averages, do some back testing, and educate yourself on, you know, not only how it works, but how you can apply it to your trading plan, how you can make yourself even more profitable using or adding indicators to help you, not necessarily to trade for you or to only base your trades off of. Of course, you should always be learning and be growing your trading plan, your understanding of what you're trying to accomplish and how you're trying to accomplish it. Which your end all be all goal with trading should always be to make money. But the way to accomplish that, there's many different methods, there's many different ways, and so you have to really identify what works best for you. And using indicators should not be your sole trading plan. The use of an indicator should only help with confirmation of whether or not you should be getting into a trade. And you just have to become comfortable with that. And the best way to do that is to back test it, to apply it to a magnitude of charts, and then go from there. So hopefully this video has helped you guys out some. I'm going to be doing this. I'm going to go over a whole bunch of different indicators and the most popular ones, maybe some ones that aren't as popular as well. And yeah, so thank you for taking the time to watch this video. If you have any questions, feel free to leave a comment in the comment section down below. I'll get back to you, or you can always send me a message on Telegram. My Telegram contact information is in the description down below. I'm always available. I get back to every single person that messages me. And if you haven't already, go ahead and hit that like button. Subscribe to the channel if you're not already subscribed. If you are already subscribed, I really appreciate your support. I'm going to be bringing more and more content to this channel as everything rolls on. So again, thank you for everybody's support. I hope that you got something out of this video. Maybe you learned something that you didn't already know, even if you already are implementing moving averages to your trading plan. So thank you guys again, and I hope that you have a fantastic weekend. And the weekly charting series video, week number 10, will be up tomorrow. So thank you guys. See you later.